Good afternoon. This is Sean Golding with Golding & Golding, here to discuss the basics of the badges of fraud. Badges of fraud is a phrase you'll see often when you're researching civil and criminal tax fraud. It's basically red flags, indicators, how the IRS approaches investigating whether or not a person may have committed tax fraud. Tax fraud is a little bit different than tax evasion. It's more encompassing. It can include uh, omitting a tax return, for example, or filing false documents, or fraudulent transfers, for example, to artificially eliminate or minimize tax liability, or other purposes. Again, tax doesn't have to be the key essential ingredient. It could be domestic or international, and the IRS has really been pushing this on the international front as well, whether it's foreign account non-compliance involving criminal willfulness and unreported income. Not and to take a step back here, not non-willfulness, right? Not I didn't know I had a foreign account, I had to report it. I didn't know that the interest income was reportable. That, of course, is not fraud. Cryptocurrency, they've been enforcing that more so, and even expatriation lately. People who try to expatriate and avoid having to pay tax or misrepresenting the status of their assets and income when they formally exit. Let's go through some of the common badges of fraud that you'll see often. Income, for example. We're going to go through the category and then items related. So income, right? Someone could intentionally omit income from their tax return filing. They may have concealed accounts overseas, even in the U.S., working with a bank to not get a 1099 so it's not reported. Smaller banks, of course, or other foreign, domestic or foreign financial institutions. It can include knowing you have foreign accounts and misrepresenting the status on your Schedule B, intentionally not filing FBAR and things of that nature. False expenditures. This is common when you see, there's things people call shadow preparers that'll go out and tell you, hey, we'll prepare the return for you, but you have to sign it. And one way that they sell you is by saying that they're going to get your income, the amount of tax that you owe, down significantly. Is false expenditures, making up a business. Oftentimes I'll see a consulting business, and that's where you're leasing your M7 and taking $200,000 trips to try to sell a widget that you don't even own, or a service that you don't even provide. Commingling your business and personal accounts or expenses. For example, you want to take a vacation. The primary purpose of the vacation is to spend time with your family or your mistress or something like that, and then trying to claim that as a business expense, and knowingly doing that. Not, if it's intermixed and there's a legitimate business, that's not the same thing. Books and records. Keeping two sets of books is common. One set of books that's the accurate records, one set of books that is not the accurate records. And if you're audited, you show the accurate records, of course, even though that doesn't actually reflect what's going on in your business. A couple more common badges of fraud would be allocations of income, making fictitious distributions that never actually happen so that you could take deductions that don't exist, or assignment of income. This is common with related parties. Joe or Jane Moneybags doesn't want to have all of the income come to them, but the income is there, so they assign it to a niece and nephew, someone else who's related, who has a much lower tax bracket, and then that person gifts it back to a family member. So the person who received it knowingly, money that's not theirs, but claiming income as though it was theirs in order to reduce the tax liability, and it leads to a tax gap, and the IRS doesn't like that. Conduct of taxpayers, if they're being audited or under examination, maybe they're not responding accurately, they're knowingly providing false information, sending the agents on a wild goose chase. They fail to make a full disclosure in an audit. I see this often when someone comes to me and they go, hey, I'm being audited for my consulting business. I have these foreign accounts. I never knew I had to report them, but during the audit, they asked if I had foreign accounts, and I doubled down. I said no. That could be a situation that could lead to a potential fraud investigation. Methods of concealment kind of goes back to the false expenditures in the books and records, making false entries into the books, concealing various items in order to artificially reduce your tax liability. and suppress the income. If you think you may have committed a fraud and it involves international, you may want to consider one of the voluntary disclosure programs if you haven't been contacted yet by the IRS. Sometimes taxpayers assume everything that they do is willful based on what they've read, and if you're willful, then you would do the IRS voluntary disclosure program. If you're non-willful, there's various other programs available to you. Excuse me. There's the streamlined procedures, there are delinquency procedures, and a reasonable cause. We got a ton of free information available on our main website and our sub-websites. You can always reach out and schedule a reduced fee initial consultation if you think it's appropriate, and it's something that we handle here. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Enjoy the rest of your day.